All right, let's talk about one of the absolute cornerstones of trading, support and resistance. Seriously, once you get this, you're going to start seeing the market in a completely new light. It's all about spotting these invisible battle lines that tell you so much about what's really going on. So let's jump right in.
So, the easiest way to think about this, just imagine the price of a stock is like a ball bouncing inside a room. You've got a floor that it bounces up from, and you've got a ceiling that it hits and comes back down. That's really it. That's the basic idea, a sort of predictable zone where all the action is happening.
Okay, so let's get a little more specific and officially define what we mean by the market's floor and ceiling.
First, we've got support, and that, of course, is our floor. Think about it. When the price drops down to this level, a whole bunch of buyers suddenly get interested. They're thinking, hey, that's a bargain, and they start buying. All that buying pressure is what stops the price from crashing through the floor and, pushes it right back up. A lot of traders will look for these floors right where the price has bounced up in the past.
And on the flip side, you've got the ceiling, which we call resistance. It's the exact opposite story. As the price climbs up to this level, the sellers start to take over. They're looking at the price and thinking, okay, this is getting a little pricey. It's a great time to sell and lock in my profits. So all that selling pressure creates a ceiling that the price just can't seem to break through. And you'll see these ceilings pop up all the time at previous peaks or even at those big round numbers, like $100.
So really, it all just boils down to this super simple dynamic. Down at the floor, at support, the buyers are in charge, and boom, the price goes up. Up at the ceiling, at resistance, the sellers are running the show, and the price comes back down. It's like a constant tug-of-war playing out right there on your screen.
Okay, that's the what, but the really big question, the one you're probably asking, is why? Why does this even work? Is it just some kind of magic line on a chart? Well, no, not at all.
See, the secret engine driving all of this isn't some super complex computer program. It's way more simple and way more human than that. It's all about market psychology. It really just comes down to how a ton of people all remember and react to the same price levels.
Let's try to get inside a trader's head for a second. Imagine the price drops to that floor. All over the world, people are looking at their screens thinking the exact same thing. Whoa, I've seen this price before. Last time it hit this level, it shot right back up. This is my chance to get in. And it's that shared thought, that collective memory, that creates the wave of buying that actually forms the support.
And now, let's flip it around. What's going through everyone's mind when the price starts hitting that ceiling? Well, anyone who bought lower is probably thinking, you know what, this has been a great ride, but I remember it had trouble breaking past this point before. I'm going to sell and take my money. It's that collective urge to cash out that creates the wall of sellers we call resistance.
But, and this is where things get really interesting, the market is never that simple, right? These floors and ceilings, they're not made of concrete. They can break. And when they do, the whole game can change in an instant.
So just picture this. The price is climbing, it gets to that ceiling, but this time, it doesn't stop. The buyers are just too strong, it punches right through. So what happens then? Well, that powerful move has a name. We call it a breakout.
Okay, so here's the really cool part. It's not just about breaking through. It's about what happens next. Step 1, the price smashes through that old resistance. But step 2, and this is absolutely key, that old ceiling, it becomes the new floor. The whole psychology just flips on its head. Suddenly, everyone sees that old resistance level as a new place to start buying. It's a total role reversal. And, as you can probably guess, the exact same thing happens in reverse. We call that a breakdown. If the price falls and crashes right through its floor, that old support level doesn't just vanish. Nope. It flips and becomes the new ceiling. All the people who are now stuck in a losing position are just waiting for the price to get back to where they bought in so they can sell. That creates brand new resistance, making it that much harder for the price to recover.
Okay, so we've covered a lot of ground. What's the main takeaway here? Let's wrap this all up.
So, here's what you really need to remember. First, the market loves to bounce between a floor, or support, and a ceiling, or resistance. Second, these aren't just random lines on a chart. They are created by pure human psychology, that constant battle between seeing a bargain and wanting to take profits. And third, and this is a big one, when a level breaks, it often flips its job. The old ceiling becomes the new floor. Just being able to spot these levels is an absolutely crucial skill for reading the market. So I'll leave you with this final thought. Think of support and resistance as the basic building blocks of the market's language. Now that you know how to see the floor and the ceiling, you've really taken a huge first step. So the real question is,
What else are you going to start seeing in the charts now?